Welcome to Crypto Clarified, Investing in the Truth, a podcast series where we come together each month to discuss the most captivating headlines and trends from the investing in crypto space. My name is Benjamin Dean. I'm director in WisdomTree's digital assets team, and I'm joined by my co-host, the one and only Jason Guthrie, head of digital asset product, also at WisdomTree. Jason, how's things going today?
Things are all right. I could use another coffee, but otherwise I'm not complaining.
We all could. Well, the good news for you today is that we've got a bite-sized episode. It's going to be relatively short, very focused. Jason and I are going to delve into the topic of transparency in crypto exposures, particularly for institutional investors. But before we get into that, we've got some housekeeping. Usual shout out to James and Sam in compliance. I need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. And with that done, let's get on to the fun stuff. Transparency in the digital asset and crypto space is a topic that keeps coming up over time as the space grows and matures. We've seen in the events of the past few months how important transparency is, particularly for institutional grade products. Before we can have a really discussion about this, Jason, we need to set some terms down. Transparency, what is meant there in relatively precise and concise terms?
For me, like transparency in markets, in products is really about, proactively providing all the relevant information so that people can properly understand what they're engaging in and understand the risks associated with it. It sort of, for me, it's much more than disclosures, which I think is what a lot of people think of, but proactively making that information available and educating those that might use it to ensure that there is, as I say, a robust understanding of structure and risks.
Absolutely. I mean, at a really fundamental level, markets can't function without information symmetry between participants. I mean, Joseph Stiglitz won a Nobel Memorial Prize in economics for precisely this topic and how in the presence of information asymmetries, markets are inefficient and ultimately fail. Applying it to the digital asset and crypto space, back in the day, Bitcoiners used to say, not your keys, not your coins. And basically, there's a couple of implicit messages there. One of them is that if you custody your own Bitcoin, holding your own private keys, you have oversight and transparency and visibility over your assets. Now, that's a bit different these days, and particularly with institutional investors. Could you explain a little bit how most institutional investors will gain access to the space and how it relates back to transparency or the set of risks that can emerge in the absence of transparency?
Yeah, for sure. So you're right that the space has evolved a long way since, a bunch of people with private keys written down on pieces of paper kept in their wallet as kind of the primary way in which people transacted in or held digital assets. And now people have a much wider variety of options. So there are still a lot of people doing self-custody, and self-custody is available whether it's individuals, retail, or institutions. This usually involves some hardware, some software, in order for you to sort of manage the holding of any kind of digital asset as well as the transactions in that. You might be using a service provider to provide you access to that, which could be a custodial arrangement, someone else managing those private keys, or a more brokerage type arrangement where you have an account with the service provider. They do something in the back end to have reserves of that currency and whatever other activities they might be doing, but you rely on that service provider. And the third one is through financial products, right? Through mutual funds. The closed-ended products are very big in the US. Exchange-traded products are the major way in Europe. And so these are kind of the three primary routes that people will go down, either sort of a self-custody model via a service provider, custodial or broker, or through a financial product.
It's been fascinating to watch as the space has changed over time. It's gone from something that really like hobbyists and technically minded people used to be the core group. And as the space has grown, institutionalized and matured, you have seen exactly those three classes of ways in which to gain exposure to the space, which are custodial arrangements, which create a whole set of new consequences and risks. Now, thinking about transparency then, and thinking about it in the crypto digital asset space, what are some of the questions that someone would want to ask themselves if they were to engage in a custodial arrangement around the transparency of the holdings and what's being done with the holdings by the custodian or the service provider or the financial service provider, more precisely?
Yeah, so this really comes back to, I think, understanding the risks involved in the nature of the arrangement that you've got, right? I think the two big distinctions, if you're going via a kind of service provider, are, are the digital assets held directly for the benefit of you as the consumer, right? There are plenty of examples out there where you have exposure to that organization, not the direct underlying. Pretty much all of the crypto exchanges, this is the case, right? As well as a lot of kind of the brokerage firms and things that we've seen out there. Voya was a really good example of this. Voyager, sorry, was a really, really good example of that, where it's more of a brokerage relationship than a sort of custodial one. A proper custodial relationship, those digital assets are held segregated, bankruptcy remote from the service provider that you're using. They're held solely for your benefit as the custodial client. There are those direct holdings. People sometimes refer to this as physical holdings, which is a sort of funny nomenclature for something that's purely digital. But the sort of salient point is that they are held, they're there for your benefit. They're not going to be commingled with any of the funds of the service provider that you're using, and those digital assets aren't used for any other type of activity. They're not lent out or anything like that, right? Unless that's something you explicitly want to opt into.
It's a funny one there, physically backed.
Yeah.
I sometimes like to say like fully backed by the assets in question, because it is just kind of a strange kind of artifact, I guess. I assume from like gold.
Exactly. It's nomenclature borrowed from other products. I mean, from things that were like physically backed financial products like gold. Physically backed also was the sort of phraseology of choice for like direct holdings of like equities, of securities, versus taking that exposure via a swap. So physical versus synthetic is the sort of historic nomenclature.
I guess if you wanted to get really stretch it, you have to store the private keys somewhere. So in a way, you could maybe start using the term physically backed. But anyway,
physical security's been a big part of it for sure.
Yeah. All right. So you've got physical exposure, and then you've got the synthetic exposure. There's one layer there. Then there's kind of a question of what are people doing with, if it is physically backed, for instance, what are they doing with the assets? Are they always there? I maybe summarize that as collateral or collateralized. Is that accurate?
Again, this comes down a little bit to the nature of the organization that you're dealing with, right? So, again, if you are simply facing off against that service provider as kind of a counterparty, and the assets aren't held directly for you, then they're likely to be involved in part of the business activity of that business. Like the best way to think about it is a bank and their lending activity, right? You've put money in there, you can see your account. It says you've got X number of dollars or pounds or whatever. But on the back end of that, they are probably running a loan book, lending this kind of stuff out, and that's just part of the kind of business activity. Now in banking, this is sort of a well-established practice. It's very regulated. There are government guarantees over deposits. That kind of arrangements don't exist in the crypto service provider space, right? So it's really important that you understand the nature of those holdings, what your service provider may or may not be doing with them, right? And the risk that puts back on you as a client of that service provider. Right, I think the two big ones that happen is lending, which we sort of talked about. So crypto lending, that's been a really high profile issue over the last kind of few months, right? Three Arrows Capital has been the big news story around this one, and how its bankruptcy has sort of caused a cascade of onward bankruptcies. And that was because, they were a lending counterparty, and I don't think everybody understood that risk, who those counterparties were. I mean, funnily enough, there's, really well established best practice for how to handle these sort of things. And the digital asset space desperately needs to look to the traditional finance world to start adopting those best practices. Transparency is at the heart of that, which, is why we're talking about it today. But it definitely isn't as prevalent as you kind of want it to be.
Yeah, even I was surprised to see the extent of the lending happening in the space, which culminated with Three Arrows Capital's bankruptcy, right? And set off a chain reaction throughout the space. I would have thought people would have looked at, like, as you say, best practice from traditional finance around those arrangements. And I would also have thought people would do more due diligence to look at, in events where there is lending of the underlying assets, who are the counterparties. It's classic risk management, really. But all right,
absolutely.
if we summarize it then in terms of transparency, you're looking to see, is it physically backed or synthetic? You're thinking about whether there's any provisions for lending occurring on the back end. And if there are, you're starting to think about questions around counterparties. Is it collateralized or not? They're the kind of questions you might ask if you just sit down and do your own research, read the prospectus. But there's one kind of word that's emerged a lot. It's partly because Ethereum's about to make a big change to its consensus mechanism to proof of stake. And in my interactions with folks in kind of the institutional investor space, when I explain staking to them, they immediately go for the analogy of securities lending. And then I have to really break down to them like how it's conceptually it's similar, but it's very different. In just a few sentences, if you were to try and help people understand how staking digital assets is different to lending, what would you say?
I think it's the biggest difference is who you're facing, what your counterparty is in this exposure, i.e. where your risk comes from, right? In a traditional securities lending arrangement, or really any lending arrangement, your risk comes from the creditworthiness of whoever borrowed the assets, right? The fact that they might not pay it back in the future, that's where your risk comes from. So you are exposed to the solvency of that business, like how good their cash flows would be, how good their management is, these sort of factors. With staking, you're participating in the protocol, and your chance of loss comes from an event called slashing, right? And that's if the technology that you're using to stake that, so you run a node, or again, you could use a service provider to kind of do this. It starts to get very technical, but it's the idea that that piece of technology doesn't do its job properly in terms of contributing to the consensus, and you get slashed. So this ends up being more of an operational risk, in my view, than a counterparty risk. Of course, if you're using a service provider, they need to do their job properly. But again, it's operational failing versus like the credit worthiness, the idea that their cash flows dry up or their business gets worse, their management is bad, that results in your financial loss. So as I say, one I view as counterparty risk, the other is more akin to operational risk.
Absolutely. I mean, as a cybersecurity person, and we could think about cybersecurity as a subset of operational risk. Staking, that's where you have to pay attention, do the due diligence. Who is the validator node? What's their track record? How efficient are they? Where are the keys stored? So on and so forth. Operational cybersecurity risk. Whereas with lending, it's, as you say, like it's the same set of risks around counterparties and solvency and collateralization as we've seen traditionally. But you've got to think about it differently, right? Now, we're coming up on time, but let's kind of summarize this now. In terms of risks, then, you've got to sit down then and well, you read the prospectus, but sometimes the prospectus, it should be clear and transparent what the terms are. If people wanted to try and identify the risks, what could the consequences be if the terms are not laid out transparently and clearly? What might be some of the implications? And we can think about along the dimensions of, whether is it physically backed or synthetic product, is there lending happening or not? What's the collateralization? What kind of consequences are likely to play out if you don't pay attention to these things?
Well, the consequences are that you're going to suffer potential unexpected losses, right? I think the worst loss that anybody ever takes in financial markets is one that they weren't expecting from a risk that they didn't know they had exposure to. This is always the most, look, if you invest in the S&P 500 and the S&P 500 goes down in value, you knew you had market risk when you went into that. That's fine, you're expecting it. But if your counterparty just suddenly ups and disappears and you lose 100% of your money because they've gone insolvent and you weren't really accounting for that, or you weren't, diversifying service providers to account for that risk, that is much more difficult to bear. So what could happen if you aren't aware of what's going on with your product, with your service provider, is that you may be wearing this unexpected loss as a result of activity that you weren't aware of. I think it's probably worth clarifying here too that we've talked a lot about sort of the custodial or service provider relationships here and the importance of transparency in that. But these principles also apply to the financial products side of things as well. And I think best practice for this type of risk management really cuts across at whatever route you choose to go down to take exposure to this asset class. You really want to be thinking about the same things. Like institutional best practice for risk management, I think applies basically equally regardless of your route to market. I think the choice of route to market is much more around like what operationally works for your organization, you personally, your workflows, etc. But what you have to think about in terms of risks you're taking on remains relatively consistent.
To close out, are there any kind of best practices you would emphasize around transparency and disclosures for institutional grade products in the space, given that, as you said earlier, there aren't necessarily the same kinds of regulations and guidelines and constraints really as we see in traditional finance in the digital asset space?
So I think first and foremost is understand how your assets are held, right? Do you have direct exposure to that underlying? Is it held solely for your benefit? Or are you exposed to the service provider and their creditworthiness, right? Understanding the nature of that relationship is, I think, first and foremost, right? This applies to financial products as well. If you're buying an exchange traded product or a fund, are they structured with a direct holding? Is that direct holding bankruptcy remote from the financial products issuer? If you're buying a structured product, right, like a note, this is likely you have exposure to the issuer. Same as a synthetically backed product, you have exposure to whoever the counterparty is. So if you want to have the direct holding, you're looking for something that is physically backed. Everyone out there should proactively provide this information to you. You really shouldn't have to go looking for it. And if you do have to go looking for it, that is a red flag, right? I think the second thing you need to look for is what is the nature of the activities inside the product itself. Are they lending out any of the assets? Are they staking those assets? If they are doing either of those activities, then policies around how they're controlled for, how the risks are managed, and what those risks are should be actively disclosed, right? You're right that like a lot of the crypto native areas aren't under regulatory purview in a lot of cases yet, or operate under kind of different guidelines. But best practices for lending, I think we said this earlier, but they're well established, right? That you should know who your counterparties are, that you should be asking for collateral receiving appropriate haircuts, that there should be, daily lists of exactly what is lent out that is published and made public. These are best practices that are easy to implement, that happen all the time in every securities lending program, in every lending program, at any asset manager. And there's no reason that this can't be the standard that we should be holding crypto service providers to as well. So proactively providing the details in either a lending or staking program, their policies, risk controls, mitigates, etc., list of counterparties, list of what's lent out. These are things that should be disclosed as well. Again, this should be really... this information should be forthcoming from whoever you're working with. It's easy to do. I think, like, if you aren't lending, say so. If you are, say so and give the details. This is a really, easy way in which to help investors understand what they're taking, and I think build confidence in the space, which is really what everybody should be trying to do.
Great. Well, with that, I think we're out of time. Jason, thanks for coming and clarifying the topic of transparency today. I hope listeners found this useful and informative. As a reminder, if you'd like us to cover any specific topics in future episodes, like we did transparency today, Or if you just want some more information, you can email cryptoclarified@wisdomtree.com. You can find Jason at GuthrieFi on Twitter, and you can find me at Benjamin Dean on Twitter as well. Thanks again for listening, and we hope you have a great day.
Thanks, everyone.